Hello, my name is Kathryn Rooney Vera, Chief Market Strategist here at StoneX. Happy New Year. 2026 does not look like a boom or a bust year. Our base case runs in two phases. Early in the year, Fed easing and contained inflation expectations allow real yields to drift lower. Financial conditions ease, risk assets stay supported as a result, and markets lean into a more positive scenario for the US economy and markets. That dynamic doesn't run all year. As the year progresses, sticky services inflation and fiscal supply pressure raise the risk of a long end repricing. The dominant risk is not earnings collapse, it's a rates reset in the back end of the year. Markets don't need inflation at 2%. They need inflation stable enough to allow policy to move toward neutral without forcing a disorderly repricing in longer maturity rates. When the long end moves quickly, correlations tighten and valuations compress across assets at the same time. In the early phase this year, we expect economic growth slows, but remains positive. Labor demand cools without breaking. Under that setup, the Fed can deliver another 50 basis points of insurance easing. That lowers the expected path of real short rates and reduces uncertainty. Real yields can ease modestly, even if inflation remains above target, because policy expectations and volatility matter as much as the inflation level. Bonds and equities can perform together through discount rate relief rather than earnings acceleration. Real yields are starting from a high place. As of the end of last year, 10-year real yields near 1% sit near the upper end of the post GFC range. That level looks restrictive in absolute terms, but markets trade changes, not levels. If the Fed eases and inflation expectations remain contained, the expected path of real short rates can move lower and probably will move lower and pull longer real yields down on the margin. The risk builds later in the year. Services inflation depends on wages, and wages depend on labor cooling. If labor demand stops cooling, wage growth stabilizes, services inflation stays sticky or gets worse, and that leads the Fed's room to ease to shrink. At the same time, large fiscal deficits, heavy Treasury issuance, all of that presents risks, and that can rebuild term premium. The long end can rise even when the Fed eases the front end. That distinction matters. A gradual rise in long rates tied to improving growth can remain manageable. A fast rise driven by inflation credibility or supply pressure or term premium tightens financial conditions, it widens credit spreads, and compresses equity multiples. So speed and source matter more than level. In my view, this remains a market driven by rates rather than growth. Earnings move slowly. Discount rates can move fast. And when rates reset, everything reprices together. Our base case keeps inflation in a higher floor regime. We're talking 2.5 to 3%. Goods inflation did the work. Housing inflation should continue to moderate with a lag. It's service based inflation that remains the constraint. Tight labor supply, geopolitics, tariffs, persistent deficits, all of that reinforces that floor. Under this setup, policy responds with insurance easing rather than emergency cuts. So nominal 10-year yields can remain broadly range bound in the high threes to low fours, even as real yields ease modestly early this year. Term premium and Treasury supply, they represent the key risk later this year. Longer maturity rates do not need stronger growth to sell off. Investors demand more compensation for duration risk during cuts if deficits are huge and issuance is huge. The Fed controls the front end, the market controls the long end. We're also watching Treasury market structure, leverage, and funding dynamics. They can amplify long end moves and spill into credit without a recession catalyst. On to AI. AI investment cycle, that's real, but this isn't the 1990s. That period benefited from many things that we do not. Fiscal surpluses, expanding labor supply, trade liberalization, and compressed inflation and term premium as a result of all of this. Today's environment features persistent deficits, tighter labor dynamics, higher structural spending. AI supports earnings and capital spending long before it expands supply enough to ease inflation. So don't bank on inflation getting erased because of AI productivity gains, at least for 2026. That framework is straightforward. Early this year, we're expecting modest real yield relief to support both bonds, duration, and equities. Later in the year, inflation persistence and supply dynamics make that balance harder to sustain. This is a risk we see on the horizon. Timing and selectivity matter now more than narratives, and rates set the tape. So the framework breaks if longer maturity rates move toward 5% while credit spreads widen materially. In that scenario, rates compete directly with equities and borrowing costs begin to bite. What we watch is simple: labor cooling, services inflation, and the long in response to Treasury supply. Those inputs determine whether easing remains constructive or whether the market forces a late year reset. Please read our piece that is out this week to elaborate more on these themes. This was kind of a highlights, and we invite you to get in touch with your StoneX sales representative or schedule a call to discuss anything further with me or our team. Thank you very much. Goodbye.